Today, we will talk about the Garn-St. Germain Depository Institutions Act. The Garn-St. Germain Depository Institutions Act was enacted by Congress in 1982 to ease pressures on banks and savings and loans that had arisen after the Federal Reserve raised interest rates to fight inflation. By removing interest rate ceilings and authorizing commercial loans, this act aimed to provide relief to financial institutions facing negative spreads on their loans. In response to high inflation in the 1970s and early 1980s, traditional banks were struggling to keep up with the rising costs of borrowing money. The Garn-St. Germain Act was intended to help these banks by allowing them to offer adjustable-rate mortgages and giving real estate owners more flexibility in managing their properties. The Garn-St. Germain Act was named after sponsors Congressman Garn-St. Germain and Senator Jake Garn, and it passed with broad support from the House and Senate. President Reagan signed the bill into law in October 1982. While the Garn-St. Germain Act aimed to help banks and thrifts, it inadvertently led to high-risk lending practices by savings and loans. These risky activities, combined with deposit insurance, ultimately contributed to the savings and loan crisis of the 1980s, resulting in a substantial government bailout. Here are 3 key takeaways. 1. The Garn-St. Germain Depository Institutions Act was intended to ease bank pressures and combat inflation. 2. The act was named after Congressman Garn-St. Germain and Senator Jake Garn, with co-sponsors including Congressman Steny Hoyer and Senator Charles Schumer. 3. Title 8 of the Garn-St. Germain Depository Act allowed banks to offer adjustable-rate mortgages. Hope this would help. Thanks for watching.